So, back in April of 2026, something huge happened, but it was kind of quiet. A single rule change unlocked the floodgates for millions of retail traders. The big question is, did we just witness the dawn of a new golden age for the everyday investor? Or did the SEC just light the fuse on a volatility bomb that's about to go off? Let's dig in and figure out what this really means.
This right here, this is the absolute heart of what we're talking about today. For years, we've all been trained to hang on every word from the Federal Reserve, right? But something fundamental has changed, and it's not about interest rates. It's about the very structure of the market. The folks trading from their phones, getting organized on social media, they now have access to some serious firepower. So what happens when millions of people suddenly get to drive without a speed limit?
All right, so here's our game plan. We're going to break down exactly what changed, look at the crazy new higher-risk tools that are now at everyone's fingertips, and get into the herd psychology that's driving all this. Then we'll tackle a really dangerous feedback loop called a gamma squeeze. And finally, we'll try to answer the big one. How do you even navigate this brand new world? Okay, so what was the big switch that got flipped? Well, it all boils down to a rule that's been on the books for decades, a kind of guardrail for small-time traders. And now, that guardrail is just gone. For more than 20 years, the pattern day trader rule, or PDT, was basically the market speed limit. It came about after the dot-com bust to stop new investors from just blowing up their accounts with super fast trading. Bottom line, if you had less than 25 grand, you just couldn't jump in and out of stocks all day. It drew a really clear line in the sand between casual investors and the pros. Now this is where it gets really wild. Just look at how stark this changes. Before, if you had a couple $1,000 in your account, you were stuck on the sidelines after just 3 trades in a week. Now, the floodgates are just wide open. Unlimited trades no matter how small your account is. This one little change could unleash an army of 20 million traders, all operating at a speed that used to be reserved only for professionals. So what was the official story from the SEC? Well, they basically said that technology has made the old rule pointless. They argue that with things like zero-commission trading and fancy broker algorithms that can watch risk in real time, that whole $25,000 barrier was just an old, clunky restriction. In their eyes, the market's plumbing got an upgrade, so the rules had to change too. They're pretty much saying the system is safe enough now to take the training wheels off. Okay, so the speed limit's gone. Now we gotta look at the cars these newly empowered traders are driving. And trust me, these aren't your grandpa's safe blue chip stocks. We're talking about highly leveraged, super fast-moving instruments that can make you a fortune or completely vaporize your account in just a few hours. And at the very top of that list, you've got zero-day-to-expiry options, or zero DTEs. Honestly, the best way to think of these are as lottery tickets for the stock market. You're basically placing a bet on where a stock is going to be by the time the market closes today. They offer these insanely leveraged gains from tiny price moves, but, and this is the important part, they very, very often expire completely worthless. Your money just turns to dust. And just look how popular they've become. It's staggering. Zero DTEs aren't some niche product anymore. They now make up half, 50%, of all options trading volume. Just let that sink in. Half of the entire options market is now based on this kind of hyper short-term, daily gambling. This is a massive shift in how the market behaves, away from long-term investing and towards intraday betting on a truly epic scale. Man, this quote just hits the nail on the head. All these new tools available to retail traders, the zero DTEs, the margin accounts, they all revolve around one incredibly powerful and unforgiving thing: leverage. So what is leverage, really? It's basically using a little bit of your own money to borrow a whole lot more to make a bet. Let's say you have $1,000. With 10-to-1 leverage, you're suddenly controlling a $10,000 position. If the stock goes up 10%, boom, you've doubled your money. But if it goes down 10%, you don't just lose 10%. You lose everything. Your entire initial investment is wiped out. It turns tiny little mistakes into total disasters. But you know, it's not just about the rules or the tools. The most unpredictable part of this whole equation is people, human behavior. And now that behavior is being organized, amplified, and even weaponized like never before. We've seen this kind of speculative mania before. This has echoes of the run-up to the 1929 crash, right? When talking about the market became everyday chatter, totally disconnected from any real analysis. The huge difference today, though, is the speed and the scale of that conversation. Back in the 20s, a shoeshine Wei could maybe influence a few people. Today, a single post on social media can reach millions of people in seconds. And this modern day fever is being fueled by what we call the finfluencer economy. You go on YouTube, TikTok, X, and charisma matters way more than any financial certification. These influencers can create these massive, synchronized swarms of traders who all just pile into the same stock at the same time, driven by this intense fear of missing out, FOMO, instead of any actual research. It's a market that moves on memes and rocket ship emojis. So here's a crucial behavioral trap you have to understand. Finfluencers love to post screenshots of their huge wins, right? It creates this powerful illusion that making money is easy. But traders fall for this trap of counting their wins while totally ignoring the brutal truth. One single, catastrophic loss from an over-leveraged bet can wipe out dozens and dozens of those small gains. The only number that actually matters at the end of the day is your total return, period. Okay, so let's put it all together. You've got the unlocked gates, you've got the speculative weapons, and you've got this swarm psychology. What happens when all of that collides in the market at once? You can get a really dangerous situation called a gamma squeeze. It's a feedback loop that can send a stock into the stratosphere for reasons that have absolutely nothing to do with how the company is actually doing. Now, to get this, we first have to understand something called gamma. Don't worry, it's not as complicated as it sounds. Think of gamma as the accelerator pedal for an options price. When gamma is high, like it is with those 0DT options we talked about, even a tiny little nudge in the stock's price can cause the option sensitivity to that price change to just explode. It creates this wild, unpredictable chain reaction where risk just accelerates exponentially. So here's how that dangerous loop works, step by step. First, you get the retail swarm, maybe inspired by a finfluencer, and they all pile in to call options on a single stock. Now, the market makers who sell them those options, they have to buy the actual stock to cover their own risk. That initial buying starts to push the stock price up. But because of high gamma, that little price move forces them to buy even more stock to stay properly hedged. And this buying leads to more buying, creating this powerful upward spiral that's based purely on market plumbing, not on company performance. And this leads us to that classic warning from the economist John Maynard Keynes. During a gamma squeeze, the market is, by definition, irrational. You can be 100% right that a stock is ridiculously overvalued, but if you bet against it, this powerful mechanical loop can completely wipe you out long before the price ever gets back to reality. And here's the kicker. This fragile situation inside the market isn't happening in a vacuum. It's colliding with these huge historical cycles that already suggest 2026 is going to be a turbulent year. You've got things like Gann's 60-year cycle, which points to similarities with 1966, a super volatile year with big market turns. And at the same time, we're in the second year of a presidential term, which is historically the weakest for the market. These outside pressures could be the spark that lights this whole volatile fire. And yet, in the face of all these underlying risks, the retail swarm, the gamma squeezes, the volatile historical cycles, some institutional forecasts are still incredibly bullish. You're seeing targets for the S&P 500 as high as 7,600. And that creates this really bizarre and frankly dangerous disconnect between Wall Street's optimism and the systemic risk that's brewing just underneath the surface. So this brings us all the way back to our central question. How are we supposed to look at this new world? Is this a bold new era of financial freedom? Or is it a carefully laid trap for millions of unsuspecting people? Well, the golden era argument is that this is all about leveling the playing field, giving everyone access to the same tools that Wall Street has had for years. But the opposing, massacre view, argues that it's a dangerous illusion, that it's really just an invitation for inexperienced traders to, pick up pennies in front of a steamroller. They're taking on massive hidden risks for tiny potential gains, often right at a potential market top. And that really leaves us with this one last thought. For decades, investors have obsessed over every single word that comes out of the Federal Reserve. But in this new world where market mechanics can totally crush fundamentals, and where millions of traders can move as one based on a single tweet, maybe the biggest risk to your financial future isn't coming from Washington anymore. Maybe it's coming from the emotional, leveraged, and highly unpredictable actions of the crowd.